Okay, good evening, everyone. Welcome to our online class. In case you can hear me, can you please let me put it on the chat button? Just confirm you can hear me from the chat room or from the chat button so I can start. Please, can you hear me? I just want to confirm before we start. All right, that's brilliant. Thank you. Thank you for the confirmation. So we're going to start straight away because we don't really have much time on our side. So the last time we met, we were able to talk about the ISB conceptual framework, and we're also able to lay some foundation into what financial reporting is all about. And obviously, we are going to take it straight from there so that we can see if we can cover at least maybe 2 standards before the expiration of our time for today. So we have IAS36 before us, impairment of assets, and we also take a look at IFRS5. Probably if time permits, we take a look at IAS10, but I think we should be able to cover probably the first 2 standards. So let's see how we are able to do that so that by next week, we should start group accounting. Okay, so IAS36 talks about impairment of assets. Impairment of assets. So that's IAS36. So I'm going to explain what impairment is. I'll differentiate between impairment and, of course, depreciation. Then we take a look at carrying amount of an asset. We also take a look at impairment losses and, of course, recoverable amount. And we'll see the accounting treatment. Then we also take a look at what we inform an entity, to carry out impairment test, okay? What we inform an entity to carry out impairment test. So we're also going to take a look at that. So the first thing is, what is impairment, all right? What is impairment? So because this is financial reporting, so I won't be surprised the examiner is trying to ask you differentiate between impairment and, of course, depreciation, okay? So impairment is economic reduction in the value of an asset, okay? Impairment is economic reduction in the value of an asset. What is that supposed to mean? I'll come back to that to explain further. So let me go to depreciation, okay? Depreciation is systematic allocation of depreciable amount on the cost of an asset, okay? Systematic allocation of depreciable amount. The cost of an asset. Okay, so let me pick out some keywords. Sorry about that. We have some keywords. We have depreciable amounts. Okay, we have depreciable amount. So what do we call depreciable amount? Now, if I want to compute my depreciation charges, for example, in a particular year, so what I do is I look at, I can use straight line method or reducing balance method. For the purpose of the exams, obviously, it's going to be around straight line method. So what do? You look at cost minus accumulated depreciation. Oh, sorry, you say cost minus residual value over number of years. Cost minus residual value over number of years. So residual value is also known as scrap value or salvage value, okay? What will the asset worth at the end of its useful life? That's what we call residual value, okay? So when you do that, you look at the cost of the asset, remove residual value if you are given. Okay, you divide by the number of years. You have what we call depreciable amount. So that figure that you have is what you call your depreciation. So you apply it on that cost of the asset so that you have to depreciate at the end of every reporting period. So why am I depreciating? I depreciate because of usage. I'm using the asset. I depreciate because of passage of time. So sometimes it's not because I use the asset alone. It could be because of passage of time. It could also be because of obsolescence, right? So that's why I have to depreciate. So obviously, if an asset is carried under cost model or evaluation model in accordance with IAS16 or IAS38, intangible asset, so I will have to depreciate, okay? Except if I carry the asset under fair value model in accordance with IAS40, that's when I don't depreciate. So obviously, depreciation will happen every year, okay? So you need to understand that that is not impairment. I'm still coming back to what impairment really means, okay? So you need to understand that. So that's why I said it's a systematic allocation, systematically. So there's a sequence that you follow, which is almost every year, okay? So that's what you are doing around that. Now, what is the carrying amount of an asset? Okay, everything I'm saying is in your note actually, so you can see it somewhere around all of that. Okay, now the carrying amount of an asset is the amount at which an asset is recognized on the financial statement after deducting accumulated depreciation and accumulated impairment losses. Okay, so when I pick up financial statement, for example, I see PPE, they wrote 50 million. That 50 million on the face of the financial position is what we call carrying amount. Okay, is what we call carrying amount. So how did they arrive at that 50 million? They would have deducted accumulated depreciation. Why is the accumulated depreciation? That means it's more than 1 year. It could be 2 years, it could be 3, 4, 5 years. They accumulate it together. So they remove it from the cost of the asset. If there are also accumulated impairment losses, they also remove it. What we have left is what we call carrying amount. So you need to understand that, okay? You need to understand that, even though the examiner is not going to ask you directly what is carrying amount, but obviously you are going to use it when you are computing impairment losses, okay? So that's very instructive. Now, let me now go to impairment losses. Impairment losses. You know, remember I already talked about impairment, and I said I'll come back there to explain, okay? So impairment is economic reduction in the value of an asset, okay? Whereas impairment loss, what is impairment loss? Impairment loss is the amount at which the carrying amount of an asset exceed its recoverable amount, okay? The carrying amount of an asset exceed its recoverable amount. So let me try to put some figures around that so that you understand. So let's say the carrying amount of an asset is, say, 500,000, for example. How do I get my 500,000? I would have removed accumulated depreciation and accumulated impairment losses. So I have my carrying amount, 500,000. Okay. I will now look at the recoverable amount of that asset. Okay. You know, we are talking about impairment losses. I look at the recoverable amount. So let's assume the recoverable amount after I've computed it is 350,000, for example. Okay. It's 350,000. So the difference between the two is 150. That is impairment loss. That is why it is defined as the amount at which the carrying amount of an asset, in this case, 500,000, exceed its recoverable amount, in this case, 350,000. So the difference between the two, which is 150, is what we call impairment losses. What is the idea around here? What is the idea around here? In my account, the asset worth 500,000. In my books of account, the asset worth 500,000. But if I needed to sell the asset, or let's say, what is the market value of that asset? Okay, what is the market value of that asset? What is the worth at the market? It's just 350. So the idea is that it doesn't make economic sense to carry an asset that's worth 350 in the market, and I'm carrying it at 500,000 in my books. Remember, I said earlier, I think on Tuesday, when we met, you know, there's something we call substance over form principle. I also take you what we call the qualitative characteristics of financial statement. And we said under the fundamental, we have two. We have relevance and faithful representation. So the whole idea is this: how will I be carrying an asset whose value has diminished? So that's why it is called, impairment is called economic reduction. in the value of an asset. So that means that asset has suffered economic reduction, okay? And IAS36 now says you have to write it down to its recoverable amount. That means to reduce it from 500,000 to 350,000. So the difference between the two, which is 150, is what we call impairment losses. So where do I take it to? I take it straight to profit or loss account. I debit profit or loss and I credit PPE, okay? So when I debit profit or loss, it increases my expenses. When I credit PPE, it reduces the value of my PPE, okay? So the issue is now is this: how do I compute my recoverable amount? Okay, the 350 I just told you about, how do I get it? I've already told you how to get your carrying amount. You simply remove accumulated depreciation from accumulated impairment losses, then you get your carrying amount. So the question now is, how do I compute my recoverable amount? Okay, recoverable amount is the IR of fair value less cost to sell and value in use. Now listen to that. Recoverable amount is the IR of fair value less cost to sell and value in use. Okay, so I have to look at my fair value. I remove cost to sell. So when I talk about fair value, what does that mean? Just think about market value. Is going to tell you the fair value of the asset is, let's say, 500,000, for example, or you can say if the entity intends to sell the asset. Okay, if the entity intends to sell the asset, it will generate 500,000. That is my fair value. Then if I needed to sell, even though we are not selling, don't forget, we are only estimating the recoverable amount so that we can see or check if the asset has suffered impairment losses. Okay, now it will now give you cost to sell. If I needed to sell that asset, am I going to incur any amount? It will give it to me. So you can say 50,000. I remove it from the 500, I have 450. So that is my net selling price. That is my fair value less cost to sell. Cost to sell is also known as cost of disposal. So the examiner can use those words interchangeably. Then I move to my value in use. We said recoverable amount is the higher or fair value less cost to sell and value in use. So how do I compute my value in use? Value in use simply means if I continue to use the asset, okay, I continue to use the asset, what will be the future cash flows that this asset will generate for me? What will be the future cash flows that the asset will generate for me? Okay, I have to estimate it. I can say in year one, we generate 300,000, in year two, 500,000, depending on judgment and a lot of estimates. So I have to project into the future. As this now says, those future cash flows should be discounted to present value. Okay, I have to discount them to present value so that I can get my value in use. Okay, I have to discount them to present value. So the examiner can give me 10%, 12%, or 8%. So all I need to do is to discount to present value. So use a formula 1 plus R raised by minus n. 1 plus R raised by minus n. So that's the formula you're going to use to discount to present value. Okay, so I have a figure. So let me just give a figure to that. Let's say after discounting to present value, I have 300,000. Okay, I will now compare with the 450 fair value less cost to sell. Then 300,000 value in use. Obviously, the 450 is the higher of the two. Okay, that becomes my recoverable amount. I'll now go and compare with my carrying amount. So let's assume in this case, my carrying amount is 600,000. My recoverable amount is 450. The difference between the two is my impairment losses because my asset the books is higher than the economic reality. As such, I have to write it down to its recoverable amount. So that impairment losses, I take it straight to profit or loss accounts. Any concern for me? Any concern? Any concern in 60 seconds? Any concern for me? Any concern for me? No concern. Okay, so we move on. We move on straight away. Okay, so that's what you need to learn around that. Okay, so now I needed to explain one more thing. Yeah, I needed to explain one more thing, although there are two actually. So I will explain one now, solve a question, then I will explain the other one. Now, what I've explained is what we call impairment test or impairment review. Okay, IAS36 is saying that entities or most companies, especially large companies, they may not be able to carry out impairment tests at every point in time, especially at the end of the reporting period, because it's going to be very cumbersome. So the standard says you can only carry out impairment tests when there are indicators of impairment. I can carry out impairment tests when there is indicators of impairment, okay? Now, this indicator can be internal or external, all right? Could be internal. So what it means is this: if I did not see any of this indication, I cannot carry out impairment tests, okay? If I did not see any of this, I cannot carry out impairment tests. So for internal indication, it could be that fire got one of my plants during the year, maybe around October, around June, July, August, September, fire got one of my plants. That could be an indicator that the economic value of that asset might have declined. So at the end of the reporting period, I must carry out impairment tests. It could also be that the performance of the asset is worse than expected. Okay, an asset that works for 20 hours is now struggling to work for around 10, 20, 12 hours. Okay, so that means the performance is declining. So it could tell me that the asset might have suffered economic value. So those are internal indicators. So you have them in your notes. Try as much as possible, to know all of this. Okay, now when I go to external indicators, okay, it could be one classic example is COVID-19 pandemic. Okay, so because of COVID-19, a lot of asset value might have declined. So that's an indication to say that my asset might have suffered impairment. It could also be changes in technological development. Okay, so you have some examples on your note over there, so you can try as much as possible to put some of them somewhere in your memory. Okay, it's very important. Okay, so that's what you need to know around there. So if I don't have these indications, I don't need to carry out impairment tests. However, there are 5 classes of assets that must undergo impairment tests, whether or not there are indications of impairment. All right, 5 of them. You must undergo impairment test. Number 1, goodwill acquired in business combination. Goodwill acquired in business combination. Number 2, intangible assets with indefinite useful life. Intangible assets with indefinite useful life. Number 3, asset classified as held for sale. Asset classified as held for sale. Number 4, intangible assets during the development stage. And the last one is okay, and the last one is asset purchase with a view to resell. Asset purchase with a view to resell. So whether or not there are indications of impairment, all those classes of assets must undergo impairment tests at the end of the reporting period. Okay, so we need to understand that. Okay, so let's take a look at one question. We're going to look at this question. Okay, I'll look at another one. I'll now explain one last thing around here before we move on to cash generating units. Okay, before we move on to cash generating units. Okay, all right, so let's look at this question. Let's look at this question to demonstrate our understanding. Okay, now I said an item of plants is included in the financial statement at a carrying amount of $350,000. Okay, at a carrying amount of $350,000. The present value of future cash flows from continuing to operate the plant is $320. The plant could be sold for net proceed of $275. Required: is the item of plant impaired, and if so, by how much? Okay, and if so, by how much? Okay, now, me looking at this question, I already know this is impairment question because of the requirement. So let's use this question to demonstrate our understanding. Now, he said, when I'm dealing with impairment, I needed 2 things. I needed my carrying amount and I needed my recoverable amount. That's it. So I now have a question. Where is my recoverable amount? If you supply me, he said a carrying amount of 350. Can you see? So I have this 350 being my carrying amount, somewhere in my memory. Okay, so all I could do is to bring it out if I'm to work it out in an exam scenario. So I'll just bring it out. Okay, so that's my carrying amount. Then I ask a question again. Give me information about my recoverable amount. I know that under that, I needed fair value less cost to sell and value in use. So when I read, it said the plant could be sold for a net proceed of $275. 5. Can you see that? Net proceed. He has already computed it for me. So I don't need to stress myself. Okay. So I already know my fair value less cost to sell. Now I needed value in use, future cash flows that I need to discount to present value. Okay. So the present value of future cash flows from continuing to operate the plant is 320. Can you see? He has discounted it for me. So I don't need to struggle. He has discounted it for me. So I look at 320 and 275. Which one is higher? Obviously, 320 is higher. Okay. That becomes my recoverable amount. I will now compare with this 350. Okay. Can you see now? In my account, the asset is, I recognize the asset as 350. Meanwhile, the economic reality is saying I can actually recover 320 from the asset. So it doesn't make sense. All right. It doesn't make economic sense. I have to reduce it. I have to, write it down to its recoverable amount. So what do? I simply debit P or L and I credit the assets with 30. 350 minus 320 will give you $30,000. All right. So that's the answer. So you have the solution there. You can go through it when you have the time. Now let's go straight away to exercise 2. Let's go straight away to exercise 2. On 31st December 20x1, an entity noticed that one of its items of plant is often left idle. On this date, the asset had a kind amount of $500 and a fair value of $325. Okay. The estimated cost required to dispose of the asset is $25,000. The asset is not sold. The entity estimates that to generate a cash inflows of $200,000 in each of the next 2 years. The discount rate that reflect the risk specific to the asset is 10%. Required. Discuss the accounting treatment of the above in the financial statement for the year ended 31st December 20x1. Requirement B. How would your answer in part A be different if there was a balance of $10,000 in the other component of equity relating to the prior evaluation of this specific asset? Okay, so when I see this question, now you look at here, it said discuss the accounting treatment. I didn't know which standard the examiner is taking me on. Okay, so how do I break down this question? Now, he said, so let me just, I said on this date, the asset had a kind amount. So here, you're already giving me a kind amount, even though this is not sufficient to say this is an impairment question, okay? Because I needed to see all those variables that will tell me this is an impairment question. And now give me fair value. He said fair value is 325. Okay, that's one of the components of what's it called now? Recoverable amount. Then it gives me cost to sell. Okay, oh brilliant, that's brilliant. So since it has given me cost to sell, I can easily remove 25 from 325 so that I have my net selling price. Then I go again. Now say if the asset is not sold, what is that? Value in use. So do I expect the examiner to say the value in use of the asset is this? No way. Don't ever expect him to say that. He said if the asset is not sold, the entity estimates that will generate cash inflows of 200,000 in each of the next 2 years. So that means I will discount for 2 years. Okay. I will have to discount for 2 years. That's what this one is telling me. I discount for 2 years. That means I will say year 1, year 2, 200,000, 200,000. Okay, I have to discount so that I can get my present value. What discount factor will I use? I will ask a question. It's going to provide it for me. He said, please use 10%. Can you see? So he has already given me. He said use 10%. So that's what I'm using. So when I use it, I get a figure. I'll now come and compare with 300. Remember the way we got 300? The fair value minus the cost of disposal, which is this 25. So that's my 300. Okay. So once I get the figure, I will now compare with the value in use. The higher of the two becomes my recoverable amount. I'll compare with the 500,000, which is my current amount, to see whether the asset is impaired. Now, can you see here now? Okay. Can you see the discounting? It gives me 347. So when I compare 347 with 300, obviously 347 is higher. So that is my recoverable amount. So I will now go and compare 347 with my 500. Can you see? The asset has suffered impairment. Why? The carrying amount is higher than the recoverable amount. So once the carrying amount is higher than the recoverable amount, you will say the asset has suffered impairment. Okay? You say the asset has suffered impairment. So that difference, 500,000 minus 347 give me 153. Where do I take it to? Profit or loss account. Profit or loss account. So you debit P or L and you credit PP. Can you look at that? Do you have any concern for me? So that I can explain the last thing you need to know around here. Okay, please look at it. Let me give you about 60 seconds. 60 seconds for you to look at it so that I can explain the last aspect. Then we move straight to cash generating units. Okay, we move straight to cash generating units. Okay, 60 seconds. Any question? There is no question. Okay, or you people are sleeping. Don't sleep. Oh. And this is not the time to sleep. Okay, this is not the time to sleep at all. This is not the time to sleep. Okay. You don't have any question for me? So let me explain the last aspect around here. Okay, let me try to check to be sure there's no question. Okay, no question yet. Okay, now let me explain the last aspect. Now, look at part B of this question. Look at part B of this question. It said, how would your answer in part A be different if there was a balance of 10,000 in the other component of equity relating to the prior valuation of this specific asset? Be with me here. What are they saying here? So let's say last year we revalue this asset. Okay, let's say the current amount was 500,000. Meanwhile, the market value, the fair value of the asset is 510. Okay, so we revalue from 500 to 510. That's what they are saying. So when I revalue, I have 10,000 and I take it to other comprehensive income. All right, I take it to other comprehensive income. It forms a revaluation reserve within my other component of equity. Okay, so this year, this asset has now suffered impairment. Okay, the asset has now suffered impairment. The asset has now suffered impairment. Normally, when an asset suffers impairment, that impairment losses is taken to profit or loss account. So the question now is this: if an asset, that has been previously revalued, is having a balance in the OCI, don't forget that that's revaluation gain. So how is it possible to now recognize impairment loss for that same asset that has revaluation balance in the OCI? It doesn't make economic sense. So I can't say an asset has suffered impairments, okay, at the same time, the asset is having revaluation reserves, within OCI. So it doesn't make sense. So the standard is now saying, if an asset that has been previously revalued has now suffered impairment, that impairment loss should first be taken to OCI. We take it out. That means we take it to zero, okay, before the balance can now be taken to profit or loss account. So now, in this case, remember that 153 is our impairment loss. In part A, I will just take the impairment loss to profit or loss. It's very simple. But in part B, the examiner is saying, assuming there's a balance of $10,000, okay? Assuming there's a balance of $10,000 in the OCI. So what will that be my answer? So simply means I will first take that 153 to the OCI and take it out. I debit OCI with 10,000. I can't debit more than what I have there, okay? So I debit it to the extent of the amount that is there, which is, in this case, is $10,000. Then the balance, remember it's 153. So what will be my balance? 143,000. I will now take it to profit or loss. Then the whole 153, I use it to reduce the value of my asset. It's as simple as that. So that's what you have here. Can you see? Debit profit or loss, 143. Then that 10,000 in the OCI, because it was credited last year. So this year I debit it, I knock it out. Okay, I will now credit PP with 153. Can you look at it? Do you have concern? So that I can explain before I move to cash generating units. Okay. Any concern for me? Okay, so we are cool, right? Okay, all right. Since we are fine, that's good. That's great. Okay, CGU, cash generating unit. So let's take a look. Now, cash generating unit. So the idea is this, what we have done so far relates to one singular asset. Is that okay? Just one asset. That's what we've done. So what happens if I have a group of assets together and that group of assets has suffered impairment? How do I go about it? Okay, how do I allocate impairment tests or impairment losses on those group of assets? If it's one asset, it's very straightforward. Just go to the assets, reduce it, and that's all. So when I have a group of assets, how do I go about it? So cash generating units are smallest identifiable group of assets that generate cash inflows that are largely independent of cash inflows from other assets. So you needed to group them together, to be able to, know the cash they generate actually. So if a cash generating unit has not suffered impairment, how do I do that? But the first thing I need to do is to get my impairment losses. How do I get that? Look at the kind amount and my recoverable amount, okay? Once the kind amount is higher than recoverable amount, then the difference is my impairment loss. So how do I now generate? How do I allocate to the cash generating unit? According to IAS36, you have to follow 3 procedures, all right? There are 3 procedures you need to follow in order to allocate impairment loss to a cash generating unit. Number 1, impair obviously impaired assets. Everything's in your notes actually. Okay, impair obviously impaired assets. Number 2, reduce goodwill to 0. Okay, reduce goodwill to 0. And number 3, allocate impairment loss balance to other assets on pro rata basis. Allocate impairment loss balance on other assets on pro rata basis. Okay, you are going to allocate it to other assets on pro rata basis. Okay, so let me try to create some scenarios here so you understand. So the first thing is impair obviously impaired assets. So you have to follow the instruction in the question. All right, you have to follow the instruction in the question. So for example, the examiner can say fire got a plant, okay, and it has been considered worthless because of that fire. That means you can't recover anything from it. That's 0. So you impair it. Is that okay? You impair with the whole carrying amount. It's as simple as that. You could also say patent that has a carrying amount of 500,000 can only be sold for 250,000. Can you see that? For a carrying amount of 500, but I can recover 250. So that means 250 is impaired already. So I also write it off. Okay. So that's what you do when it comes to impair obviously impaired assets. Okay, when it comes to impair obviously impaired assets, so you just follow the instruction in the question. Then after that, you now go to the next procedure: reduce goodwill to 0. No matter the kind amount of goodwill, reduce it to 0. But you cannot reduce. You have to be sure that the impairment loss that you have left after you have done procedure 1 or step 1 is sufficient to reduce goodwill to 0. Okay, you have to be very sure that it's sufficient to reduce goodwill to 0. Okay, so once it's sufficient, then you are good to go. Okay, you are good to go. Then you now go to the last part, the balance that is remaining. So let's say I have 200,000 impairment loss. I have allocated 150, maybe 50 to obviously impaired asset, 100 to goodwill. I have 50 left. Okay, I will now allocate the 50 that is left to other assets that is remaining. How do I do that? That's what they call on pro rata basis. Okay, on pro rata basis. All you need to do is, let's say there's machinery there. Take the carrying amount of the machinery, divide by the total carrying amount. So let's say you have machinery, furniture, and fittings. Add their carrying amount together. So you now pick machinery. You pick the carrying amount, divide by total carrying amount, then multiply by that impairment loss balance. Whatever figure you have is your impairment loss. Okay, you do the same for furniture and fittings. So let's take a look at a question to demonstrate what I'm trying to explain to you, so that you have a better understanding. Okay, so that you have better understanding. Tinubu has identified an impairment loss of 41 million for one of its cash generating units. Let's assume I was not giving this, I wasn't giving, sorry, I wasn't giving this 41 million. How will I know? All you need to do is to look at the carrying amount. Can you see? This is my carrying amount. Okay, I have my carrying amount here, and I look at my recoverable amount. Can you see that? So I have my recoverable amount. So I simply remove my 150 million from 109. I'll still have 41 million. Did you see that? So that's how you get your, your what's it called now? Your impairment loss if I'm not giving, but it has already given me, so that's fine. It now said the current amount of the unit asset was 150, whereas the unit recoverable amount is 109. The draft value we're giving. It now said the net selling price of the unit asset was insignificant except for property which had the market value of 35. The net monetary asset realized in full required. How is the impairment loss allocated to the cash generating within the cash generating unit? Okay, so if I want to do this question, I have to do it in a table. Anytime you are doing questions on cash generating unit, it has to be on a table. Okay, it has to be on a table. So what do you do here? It has to be on the table. So what do you do here? Okay, now I'll list all my assets. You list them out. Okay, then with their carrying amount. So the next column will now be impairment loss. Then the fourth column will be carrying amount after impairment loss. So just like the way you have here, can you see? So most likely you're doing 4 columns. Okay, now I will now start. So I want to allocate this 41 million to a CGU. Okay, that's my impairment loss. How do I allocate it? I remember my principle. You cannot use your head to do it. You have to go to the standard. Is that okay? You have to go to the standard. I can't use my head to do it, okay? So what will I do here? Okay, now I'll go to the standard. What the standard say? It said impair obviously impaired assets. Then I ask a question. Do you have any information about obviously impaired asset? So I will read. It said the net selling price of the unit asset was insignificant, except for property, which had a market value of 35 million. Wow. Okay. Property has a market value of 35 million. My class, I have this question for you. Grab your keypads, go to the chat room. Property. Is property impaired? I needed your answer. Okay. I need your answer before we move on. Property. Is it impaired? I was told that property had a market value of 35 million. I need your answer, please. I need you to respond. Is property impaired? Okay. Somebody is saying yes. Can you explain why do you think property is impaired? Okay. I need more response. I need more response. Is property impaired? Why is it impaired? I need to know. I need responses from you so that I'll be sure that you are getting what we are doing. Somebody just responded yes. Can you explain why do you think property is impaired? Then I need one more response before we continue. Okay, I'm waiting. Oh, hey, oh yeah, so that we can move. Oh yeah, so that we can move. Oh yeah, so that we can move. Property is it impaired? You are not answering. Oh, you are not answering. Hey, how do beg by me? Oh, we are not answering. Hey, okay. So that means you are sleeping, Abby. You have been sleeping. Okay. Let me explain. Let me explain so that we can move on. But I'm not happy that we did not answer. But it's fine. But let me explain. Now, the current amount of property is 20. In my books of accounts, I have property to be 20. But the market value is 35. That means if I need to sell this property now, I will sell it at a gain. Because what I have in my account is 20. The market value is higher. That's the recoverable amount. It's higher than the current amount. The asset is not impaired. Okay? So the answer is no. Property is not impaired. Okay? So that's how you need to test to be sure that you understand this. Okay? It looks so simple the way I teach, but you need to go back and pick it up and make sure you understand. It's actually simple. Okay? It's actually simple, but the fear of ACCA, fear of ICANN and all of that is always, paramount in the minds of students. So that's why everything is difficult. Okay? So it's not impaired. So that means there is no obviously impaired asset in this question. That's the meaning. I move to step 2 straight up. Okay, step 2 says reduce goodwill to 0. So I come to goodwill, I reduce it to 0. Can you see that? So that's why you have this 13. So that I can have 0 here. Okay, then the balance. So but out of 41, I've allocated 13. So I have 28 left. I will now allocate 28 to machine, vehicles, patents. They already told us that net monetary asset will be realized in full. Okay, even if they didn't tell me it's a current asset, I mean, you can't use IAS36 on current asset. For example, they put receivables there. You cannot use IAS36 to impair receivables. Okay, use IFRS5 financial instrument. So that's what you do there. Okay, so that's what you do. So you now pick this machinery. This is 49, 35, 14. Add it together. That should give me 98. So I'll now say 49 over 98 multiplied by 28. How do I get that 28? I only allocated 13 out of 41. I multiply it. So when I do the computation, I have 14. I also say 35 over 98 multiplied by 28, I have 10. Then 14 over 98 multiplied by 28, I have 4. So when I remove it, I have this figure. So normally, if you do CGU question, you know whether you are right or not or wrong. Can you see? So you know that's it. So let's look at one more. Let's look at one more question. Any concern for me? Let's look at one more question. There was a factory explosion. There was an explosion in a factory. The kind amount of the assets were this. Required. Discuss with computations how any impairment loss will be accounted for. Okay, so what do we do here? I draw my table again. Okay, I draw my table again. So after drawing my table, so what do? I remember my procedure. Impair obviously impaired assets. Then I ask a question. Where's my obviously impaired asset? But before then, how much am I going to allocate? I look at the kind amount. He said the kind amount is 226. Can you see that? Then what's my recoverable amount? You already told me that the net selling price is how much? 1.2. Can you see? For the factory. And the value in use is 1.95. So value in use is higher than the fair value less cost to sell. So automatically, value in use becomes my recoverable amount. So I compare with this 2.6, the asset is impaired because the kind amount is higher than the recoverable amount. What's the difference? Is that 650? Yeah, that should be 650. Okay, so I have 650 to allocate. I now ask a question. Is there any obviously impaired asset? If you tell me, he said half of the machine has been blown to pieces, but the other half can be sold for at least their kind amount. Can you see? I'll now go to machine. He said half of this machine has been blown to pieces. What's the half? 150. Okay, I write it off. That's it. They now said patents have been superseded and are now considered worthless. I go to patent. They say patent is worthless. I take it to 0. That's it. So out of my 650, I have allocated 350. I have 300 left. Can you see? I have 300 left. I go to step 2, reduce goodwill to 0. This is 100. Out of my 300, I have 200 left. Okay, so I have not touched computers and building. I will now allocate that 200 on computers and building. What do? I add these two kind amounts together. It gives me 2,000. I will now say 500 divided by 2,000 multiplied by the 200. It will give me 50. I also say 15 divided by 2,000 multiplied by the 200 to give me 150. So that's what we did there. Can you see? 50, 150. Then this is the 50 for the half of the machine that has been blown to pieces, and patent is now worthless, and goodwill will reduce to 0, and that is the end of that question. That's the end of IAS36. Any question for me? Any question for me? Any question? The question I ask you is no answer. Then you did not you did not answer. Then and you're not asking me questions. Please ask questions. No question for me. Okay. Okay, so you have some questions there and you have the solutions to that. So you can do some practice. You have some practice questions as well. If you need my guidance on that, you can let me know. I will be glad to put it through. So let's quickly start IFRS5. Let's see whether we can conclude it. If we can't conclude, we finish it off in our next class. Okay. We'll finish it off in our next class. Okay. Okay. IFRS 5 deals with assets held for sale and discontinued operations. Okay. Assets held for sale and discontinued operations. Okay. So normally, if I have an asset, okay, if I use that asset for an administrative purpose or in production of goods and services, I will apply IAS16, property, plant, and equipment. Okay. If I have an asset that I hold for capital appreciation or to earn rental income, in that category, you always have land or building or part of land or building or both. Okay, in that case, I apply IAS40. Then if I have an asset that I hold in the ordinary course of business for sale, okay, that should be inventory. So I apply IAS2. Now, is that possible for me to say the kind amount of my asset can only be recovered through sale rather than continuing use? What does that mean? I have an asset that has a kind amount of 500,000. If I continue to use the asset, I may not earn or gain or recover the 500,000. The only thing is I have to sell it for me to get that money. Okay, so in that case, I can classify it as held for sale. So the standard around that is IFRS5. Now you begin to wonder to say, I want to sell my asset. So why am I having a standard around sale of asset? The idea is if the classification is not governed by a standard, then entities can use it to manipulate their reported their performance or reported profit, as the case may be. Okay, so IFRS 5 will apply if, or let's say, asset will be held for sale if its kind amount will be recovered through sale rather than continuing use. And for you to classify an asset as held for sale, two conditions must be met. Okay, two conditions must be met. Number one, the asset must be available for immediate sale in its present condition. Number two, the sale must be highly probable. Those are the two conditions that needed to be met. Okay. Now, the standard now goes further to say, for the sale to be highly probable, 5 conditions must be met. Okay. For the sale to be highly probable, 5 conditions must be met. Number one, appropriate level of management must be committed to a plan to sell the asset. Number two, an active program to locate a buyer must have been initiated. Number three, the price offered for the asset must be reasonably in line with its fair value. Then number four, the sale is expected to occur within the next 1 year. And the last one, number five, there's no plan to withdraw the asset from being sold. Okay, so effectively, you have 7 conditions that need to be met before an asset can be classified as held for sale. Listen up, 7. If you meet 6 of them, you cannot classify it as held for sale. Remember, all those conditions must be met at the reporting date. So for example, if I'm preparing my account in 2020, December 31, 2020, all the conditions must be met. If you meet that condition January 1st or January 2nd the following year, you cannot classify it as held for sale. Okay. Now, so let me try to pick up those points one by one. I will explain. We'll look at some scenario questions. Then I'll go straight to measurement. Okay. So let's see whether we can complete that. Then we have discontinued operations that will be left, and we can complete everything. That'll be fine. Okay. Now, the first condition says the asset must be available for immediate sale in its present condition. What does that mean? You have to listen to me here. This standard is very common among the examiner, whether ACCA or ICANN. It doesn't matter. Okay, almost every diet you are seeing them asking this question. So let's say this is my asset. I wanted to classify this asset as held for sale. The condition is saying this asset must be available for immediate sale in its present condition. The way it is, I should be able to sell it. What does that mean? If there is a defect on this asset, that I need to fix that defect, and I have not fixed it as at the reporting date, I cannot classify it as held for sale. Okay? I cannot classify it. It has to be available for immediate sale. Like it's as good as, oh yeah, buy it. Where's the money? Yeah, take it. Okay, so there is nothing to be fixed. You know that someone said that even if you want to rent some house, they'll tell you pay first before they go and do some things or whatever into that in that house. That means it's not available for immediate sale in its present condition. Number two, the sale must be highly probable. For the sale to be highly probable, we have 5 things. Appropriate level of management must be committed to a plan, okay, to sell the assets. Who are the appropriate level of management? Those charged with governance. It could be the board of directors, it could be management at that level. Okay, that's what they say, appropriate level, not just within your department or within your unit to say, well, you are just deliberating on sell this asset. No, appropriate level, people that has authority. Okay, so they must have decided. They must be committed to a plan. Must, not should, not may, must be committed to a plan to sell the asset. How do you know? You can obtain a minute of board meeting where it has been resolved that those assets should be sold. Number two, an active program to locate a buyer and complete the plan must have been initiated. An active program to locate a buyer and complete the plan must have been initiated. Have you seen in the newspaper before where they are making advert on some property or on some plant and machinery? That is the kind of program to locate a buyer. Maybe you have done adverts, you have consulted some experts, some consultants and all of that. Okay, so you have started, okay, to locate a buyer. That program must have started, okay, at the reporting date. Don't forget. Number 3, the price offered for the asset must be reasonable in line with its fair value. What does that mean? I want to sell this asset at 5 million. Meanwhile, the fair value is 3.5. It's not reasonable. It has to be at par, at least for the purpose of the exams. Okay, once it's higher than the fair value, you cannot classify it as held for sale. Then number 4, the sale is expected to occur within the next 1 year. What does that mean? If I'm classifying that asset as held for sale as December 31, 2019, I should be able to sell it on or before December 31, 2020. So the sale is expected to occur within the next 12 months, okay? However, the standard says if the company or an entity is unable to sell the assets as a result of issues that are beyond their control, they can continue to classify the asset as held for sale, provided all the conditions are met at the balance sheet date. Okay, so that's it. Then the last one, there's no plan to withdraw the asset from being sold. What does that mean? I can't say, okay, let me put it as held for sale. Then later I can reclassify it as normal asset. No way. So why is it like that? Why do we even have IFRS5 governing assets held for sale? Let me open your eyes a little bit better. Now, when an asset is classified as held for sale, whenever an asset is classified as held for sale, 3 things will happen. Number 1, they are represented separately on the face of the financial position. They are represented separately on the face of the financial position. What does that mean? That asset is within PPE. What is PPE? Property, plant, and equipment is within my PPE. Then one of them, I needed to classify it as held for sale. I will have to remove it from the PPE and I'll say asset held for sale within current assets. Okay, because I need to sell it in the next 12 months. So it falls within current assets. All right. So I call it asset held for sale. That's the first thing that will happen. Number 2, assets held for sale are subject to annual impairment tests. They are subject to annual impairment tests. Remember, I told you earlier on that before you can carry out impairment test, there must be indicators of impairment, which can be internal or external. However, there are 5 classes of assets that must undergo impairment test. If you can remember, goodwill acquired in business combination, intangible assets with indefinite useful life. And I told you number 3 is asset held for sale. Did you see that? So that's where it's coming from. So asset held for sale must undergo impairment test. And the third one, assets held for sale are no longer depreciated. Okay, you don't depreciate current assets after all. Okay, but they can suffer impairment, maybe in accordance with IFRS 9, as the case may be. Okay, so assets held for sale are no longer depreciated. So the idea is this: if you are a good accountant or a fraudulent accountant, let me say it like that way, and you want to manipulate your reported result, you can decide to classify some assets as held for sale because you know that they will not suffer depreciation, so that you can improve your profit for the current period. Okay, and afterwards you reverse them back or you take back those assets. So that's why you have all these rules that needed to be met before asset can classify as held for sale. So that's it. That's it. So the examiner can play around any of these conditions. So all you need to just be sure is, those conditions displaying around, those conditions are being met. So let's take a look at the question to demonstrate our understanding. The requirement says, can the manufacturing facility be classified as held for sale? On 1st December 2023, a company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. They have met 2 conditions already. Appropriate level of management must be committed to a plan to sell the asset. An active program to locate a buyer and complete the plan must have been initiated. Can you see? They have met that condition. Okay, so this condition is already met here, but that is not sufficient for me. I need to read further. The company does not intend to discontinue the operations currently carried out in the facility. This is a trigger for me. Okay, this is a flashlight. They did not intend to discontinue the operations currently carried out. That's a red light. Okay, at 31 December 2016, there is a backlog of uncompleted customer orders. Oh, yeah. This is another red light. Okay, the company will not be able to transfer the facility until after it ceases to operate at the facility and has eliminated the backlog of uncompleted orders. This is not expected to occur until spring 2024. Can I classify it as held for sale? The answer is no. I cannot classify it as held for sale. But in your exams, you can't tell the examiner no and you move away. No, you have to explain why. Okay, I can't classify it as held for sale just because the asset is not available for immediate sale in its present condition. That is the answer. That is the answer. So you can see your answers there. You can pick it up. So you have exercise 2. You can take a look at it. Okay, let's look at exercise 3 again to further solidify our understanding. ISOP is preparing its financial statement for the year ended 31st December 2007. On 1st December 2007, the entity became committed to a plan to sell a surplus office property and has found a potential buyer. Brilliant. Okay. On 15 December 2007, a survey was carried out and it was discovered that the building had a dry rot and substantial remedial work is necessary. What is this telling me? The asset is not available for immediate sale in its present condition because of the dry rot. The buyer is prepared to wait. Now, the examiner wants to use this to confuse you. He said the buyer is prepared to wait. Wait for what? It doesn't matter. This is not part of the condition, okay? This is not part of the condition. It's ready to wait, but the property will not be sold until the problem has been rectified. So the fact that the property is not available for immediate in its present condition means I cannot classify it as held for sale. Let's look at the part B of that question. A subsidiary entity B is for sale at a price of 3 million. There has been some interest from prospective buyers, but no sale as of yet. One of the buyers made an offer of 2 million, but the director also rejected the offer. Okay, Directors have just received an advice from the accountant that the fair value is actually 2.5. They want to sell it at 3 million and they have decided not to reduce it. Can they classify it as held for sale? No way, because the price offered for the asset is not reasonable in line with its fair value. It's as simple as that. As simple as that. Okay, any concern for me? Any concern for me? No concern, Abby. Okay, there's no concern for me. That's fine. That's fine. So let's take a look at measurement. So we assume that the conditions has been met. Okay, we assume that the conditions has been met. So what will be the measurement? Value. How much are we now going to recognize assets held for sale? According to the standard, assets held for sale are measured at the lower of their kind amount and fair value less cost to sell, the lower. So all I need to do is I get the kind amount of that asset, I'm bringing it from PP. I will look at fair value less cost to sell, the lower of the two. That would be my, what's it called? The new value for that asset. So let me give an example. Let's say the kind amount of the asset is 500,000. Fair value less cost to sell is 600,000. Which one is the lower? The kind amount. So I continue to carry it at 500,000. On the other hand, let's say the fair value less cost, the kind amount is 500,000. Okay, fair value less cost to sell is 300,000. Did you see that? So that means I will write it down from 500 to 3,000 because I have to go for the lower. Okay, so something has happened there. I have to write it down from 500 to 300. Something has happened. What has happened? Impairment. Impairment loss. So that 200,000 or 200, I take it straight to P or L because I have to write that asset down. So that's what this is saying. Where fair value less cost to sell is lower than the kind amount, the item is written down and the write down is treated as impairment loss. Okay, so that's that. So let's now take a look at a question to demonstrate our understanding. I've actually explained all of this earlier. Okay, now so let's look at this question. It said on 1st January 2021, Mitchell Co. bought a chicken processing machine for $20,000. It had an expected useful life of 10 years and a new residual value. On 30th September 2023, Mitchell Co. decided to sell. Can you see? So to sell, we wanted to sell. So this might be IFRS5, okay? The machine and start actions to locate a buyer. Okay, the machine are in short supply, so Mitchell Co. is confident that the machine will be sold fairly quickly. Its market value as at 30th September was 13.5 and it would cost 500 to dismantle the machine and make it available for the purchaser. The machine has not been sold at the year end. Required at what value? Can you see? Value. It's not asking me for recognition criteria now. It's asking me the measurement criteria. Okay. At what value should the machine be stated in Mitchell Co. as at this date? So the conditions are met already. So how much? And I know in my head that assets held for sale are measured at the lower of their kind amount and fair value less cost to sell. So all I need to do is this. I will ask the question, where is my carrying amount? He did not give me, unlike the question we've been solving. So I needed to compute it. So if I need to compute, I need the cost of the asset. So he has already given me. He said the cost is 20. Can you see that? He said the cost is 20,000. Then I asked, do you have residual value? He said near residual value. Can you see? You have to ask the right questions. Then those questions will be giving you answers to your questions. Then what is my number of years? He said 10. So when I divide 10 by 20, it gives me 2,000. So that means I will depreciate 2,000 per year. Meanwhile, I bought it 1st January 20x1. This is key. The date is very key. Okay. Now, it now said on 30th September 20x3. Can you see? This is when we decide to sell. Okay. And the day we decide to sell and we classify it as held for sale, depreciation will stop. Remember, I explained that. Depreciation will stop. So that means I will have to depreciate December 20x1. I depreciate December 20x2. Okay. When I get to 20x3, I have to prorate. So I will have 9/12 because January to September is 9 months. So I have 9/12 multiplied by 2,000. That will give me 1.5. So I have 4.5 in total to depreciate. I remove it from this 20 so that I can have 14.5. It's as simple as that. I have gotten my carrying amount. I will now go to fair value less cost to sell. You already said 13,500. Can you see? So I have 13,000. So which one is the lower? Obviously, fair value less cost to sell is the lower. So I will have to write that asset down from 14.5 to 13,000. The difference, which is that 1.5, I take it as impairment loss. Can you see? So this is what I was explaining. Okay, so you have 2,000 year 1, 2,000 year 2. In year 3, it will be 1.5 so that you can have this 14.5. So when you come to fair value less cost to sell, you have 13. So that means you are going to carry the asset at 13. So that 1.5, let me see. Okay, this is it. Impairment loss of 1.5 is incurred. So you have to write it down. It's as simple as that. Once you know that principle, you are good to go. Seriously. Once you know the principle, you are good to go. Okay, so you can look at exercise 5. It's the same principle. Just apply that principle. Okay, you can look at it. So let me quickly explain the discontinued operations. Any concern for me? Let me give you about 60 seconds. Okay. Let me give you some 60 seconds. Can you look at that? Okay. So look at that. Okay. So in case you have concern, we are running out of time. So let me see. Sorry. Okay. So if you don't have any concern, I think we can continue. Okay. I think we can continue, right? Okay. Now look at discontinued operations. The discontinued operations, how do I explain that? Okay. Okay, let me give let's say KFC, for example. Okay. You see, you have KFC on the mainland, let's say at Keja. You have KFC on the island, let's say at VHI. On the island, Lekki, Aja, and all of that. Okay. So they have branches, you can call them operations across Lagos, or you have a mobile phone, or a mobile or a telecommunication company that is geographically located. For example, you could say North Africa, West Africa. So those are operations, all right? So we now decide to stop one of those operations. That's what we call discontinued operations. So that's why a discontinued operation is a component of an entity that has either been disposed of, okay, or is classified as held for sale. What does that mean? During the year, I have disposed one of them. So that means at the year end, I'll take it as discontinued operations, or I intend to sell it. So at the year end, I will classify it as held for sale. Is that okay? So that is why it is called, or is defined as, discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale. It represents a separate major line of business or geographical area of operations, right? So it represents a separate major line of business. For example, okay, your company, you have separate line of business, you have estate management, you have transport business, and the other you're also doing consulting. So that's a separate major line of business. Or you class it or categorize it under geographical operations, or is a part of a single coordinated plan to dispose of a separate major line of business or geographical operation. It's a subsidiary acquired exclusively with a view to resell. So that is the discontinued operations. I will not be surprised the examiner asks you, what is discontinued operations? Okay, now, if I have a discontinued operations that I need to classify as held for sale, certain conditions must be met. The good news is that it's the same conditions that we learned under asset held for sale. But here, you will now say the operation must be available for immediate sale in its present condition. So instead of using assets or a disposal group, what you use is operations. Okay, so what you are going to use is operations. Okay, and the same must be highly probable. For it to be highly probable, a probable level of management must be committed to a plan to discontinue the operation. So that's it, just replacing assets with operations and all of that. Okay, so that's the recognition criteria. So how do I now account for a discontinued operation? Okay, how do I account for it? I will look at the total sum. Okay, the total sum of the post-tax profit or loss of the discontinued operations, the post-tax profit or loss of the discontinued operations, and number two, the post-tax gain or loss recognized on the measurement of fair value less cost to sell. Okay, the post-tax gain or loss recognized on the measurement of fair value less cost to sell should be presented as a single amount in the statement of profit or loss account. So I'm going to use the question to profit or loss of discontinued operation, then the post-tax gain or loss recognized on the measurement of fair value less of cost to sell should be represented separately or as a single amount in the statement of profit or loss. So let's take a look at this question. Then I will look at this question to demonstrate that. Then we say bye-bye to yeah, I'll say bye-bye to IFRS5. Oh, so let's just try to finish up so that next week I will quickly deal with IS10, then you can quickly start group accounting. Okay, now, so let me look at this question. Okay, here it said, explain whether each of these subsidiary meets the definition of a discontinued operations. Okay, now the Portugal group of companies has a financial year end of 38 June 20x4. This is key. That's very key, that date. Okay, so that means the beginning of this year will be 1st July 20x3. That's the meaning. Okay, so we now say that a subsidiary, England, was sold during the year. Can you see? 1st January 20x4. Okay, subsidiary England was sold. So when I'm preparing my account at the end of the year, which is 30th June, will I take it as a discontinued operation? The answer is yes, because a discontinued operation is a component of an entity that has either been disposed of. So I have sold subsidiary England during the year. So when I'm preparing my account, it will not form part of my continuing operation. So to be a discontinued operation. Okay. It now said, next one, on 1st January 20th, announcement was made that there was advanced negotiation to sell subsidiary Switzerland, and as subject to regulatory approval, this is expected to occur by 31st October 20x4. So January 4, during the year, okay, there was an announcement that I needed to sell Switzerland. There were advanced negotiation. That means they found a buyer, they have agreed on the price and all of that. All we're waiting for is regulatory approval, and we have to sell it by October. So when I get to 30th June, when I'm preparing my account, can I classify it as held for sale? Because I'm not sold it. Okay. Can I classify it as held for sale? The answer is yes. I can classify it as held for sale because we are finalized. We're only waiting for regulatory approval. Okay. Now the board has also decided to sell a subsidiary called France. Agents have been appointed to find a suitable buyer, but none have yet emerged. The agent advice is that the potential buyers are deterred by the price. That means the price offered for this France is not reasonable in line with its favor, so I cannot classify it as held for sale. On 10 June 20x4, an announcement was made that an entity subsidiary, Croatia, was for sale. It was sold on 10 September 20x4. Can I classify it as held for sale? My class, listen to me here. Be with me here. Okay, it said on 10th July. 20x4, and my accounting year end is 38th June 20x4. I made an announcement after the year end, okay, that I needed to sell a subsidiary, and I sold it in September. Can I classify it as held for sale as at the year end? The answer is no. Okay, this is not within the reach of IFRS5. It's within the reach of another standard, which is IS10, event after the reporting period. Okay, so I'm going to take you that standard. Okay, so I have one more question here. I'm not sure. Let's quickly look at this question. I think we should be able to look at this question before we go. Let me do that in 3 minutes. Okay, it's very straightforward. Now here, they were telling us stories required. Now said, discuss the condition which must be met for a non-current asset to be classified as held for sale, and explain the accounting treatment that applies when such classification is deemed appropriate. You should be able to handle that. I've told you. Okay. Now, even if you cannot handle it, you have the solution they would have explained, so I don't need to say that again. Now, Bangboshe PLC is a long-established travel agent operating through a network of retail outlets and online stores. In recent years, the business has seen its revenue from online store grow strongly, and that of the resale store decline significantly. On 1st July 2017, the board decided to close the retail store. Can you see? They want to discontinue that operation at the financial year in 31st December 2017 and put the building up for sale on that date. The directors are seeking advice regarding the treatment of the building in the statement of financial position, as well as treatment of the trading results in the retail division. So the figures are as follows. So we're giving the current amount of building, fair value less cost to sell, and other expected cost. So we're giving this trading result. That's like your E or L. Now said, outline the conditions. Can you see again the conditions which must be met in order to present the result of operations as discontinued, and the accounting treatment that applies when such classification is deemed appropriate? It's repeating this part A, the same question. Can you see? Now, draft the statement of profit or loss for Bangboshe for the year ended 31st together with comparative figures. So what do we want to do here? You know, we are in 2017. So that means when I'm doing 2016, I'll still have this retail outlet. But when I'm doing 2017, I'll take this retail outlet as discontinued operations. So let me show you. Okay, so this is my 2016. How did we get this 66 in 2016? Okay, so I simply had this 18 and 48. Can you see? Because I need to show it. But when I come to 2017, I will only have for the online. Can you see? So that's how you have 58.5 there. Okay, so that's why you have 58.5 there. Okay, then the same thing with my cost of sales. Okay, so my cost of sales here for so you have 19.5. Can you see 19.5 here? So you had 16.5 and 13.5. Okay, so that you can have your cost of sales. So I have my gross profit. Okay, so for my operating cost, I also bring for 2016. I add it together. Then for 2017, now look at my operating cost here. I have 15. Then in the question, I was given other expected cost of closure. So I'm going to add it to that. That's 5.85. So that's what I did here. Can you see? So 15, 5.85. That's how you have working notes 2 here. Okay. All right. So that I can have profit for the year from continuing operation. Okay. So I will now remove loss for the year. How do I get the loss for the year? You know, we said earlier that measurements, you have to look at the post-tax gain or loss of the discontinued operation. So it has already given me here. Can you see? For that retail outlet, I have 4.5. That was a loss. Okay, so you bring on the loss here. So you now also look at the post-tax. What's it called? No, the first one is post-tax profit or loss of the discontinued operation. The second one is post-tax gain or loss. as a result of measurement of fair value less cost to sell. So you now go to the question, where's my fair value less cost to sell? I think we have it. Okay, can you see? So this is the current amount and fair value less cost to sell. So if you look at the fair value less cost to sell, it's lower than the current amount. So the difference between the two, okay? So that difference between the two, this means 4.2. So you add it together to have this 8.7. So that's what you bring here because it's a loss. So there's no loss here so that you can have profit for the year. And that is the end of that question. That is the end of that question. Any concern for me before we call it a day? Any concern for me? Any question? There's no question, right? You gotta look at it. If you have questions, please, you have my phone number. I will always be glad to answer you. Somebody saying, sir, okay, what do you want to say? Do you have any concern or you are okay? Let me know. Or you go and sit on it and you have issues. Let me know. So the next time we are meeting, I will, let me see. Yeah, I'll quickly explain IS10. Okay. Can probably introduce you to group accounting. So we do group accounting next week. Or probably come back to standards. The other one do cash flows. Okay. All right. So that should be fine. Okay. Any other concern? No concern. You're not typing again. I thought you wanted to say something. Okay. Okay. So if there are no concern, let me leave you to the end of God. I'll see you next week by God's grace. But in case you have issues, please feel free to call or say chat to me. Okay. Okay. Previous example where we have July. Okay. Let me see if I can quickly do that. Okay. You're talking about this. This is 10th July. You know, that's why I highlighted this date. This is the end of the year. You know, I said earlier that before you can classify as an asset or discontinued operation asset for sale, the condition must be met as at the year end. Okay, so I have left the year end on the 10th of July. After the year end, they made an announcement. It's not within the reach of IFRS5. It's within the reach of IAS10. So when we discuss IAS10, you might likely understand better. Is that okay? You might likely understand better. So this is outside IAS10 because it's outside, outside IFRS5 because it's not within the year, okay? So that, date is very important. If you look at 1st January here, okay, it was sold during the year. England was sold during the year. So I will take it as its continuing operation. Can you see? Okay, so that's it. Thank you for your time once again. I really... Oh, you might need to listen to the video again. We're talking about October. Now listen. They said on 1st January 20x4, during the year, an announcement was made that was advanced negotiation to sell subsidiary Switzerland. They made the announcement. There were advanced negotiations. They have found a buyer. Is that okay? They are now waiting for regulatory approval and is expected to occur by 31st October. We said earlier, part of the condition is that the sale is expected to occur within the next 1 year. So when I'm preparing my account at 30th June, I'm expecting to sell in October 20x4. Is within the next 1 year. So I'll classify it as held for sale because there were advanced negotiation already and it was done during the year. Okay? It was done during the year. If you don't still understand, please call me. I'll be glad to explain further. But you should be able to understand. Okay? Listen to the video again. You should be able to understand. Thank you for your response. I appreciate you. Good night. Take care. See you next week by God's grace.